Hello, I'm Greg Hunter. Thank you for joining us today on USAWatchdog.com. We have back with us today Dr. Lawrence Kotlikoff from Boston University. He has a PhD in economics, and he works at Boston University, PhD from Harvard University. Dr. Kotlikoff, thank you for joining us today on USAWatchdog.com.
Happy to be with you, Greg.
And I just want to kind of extend your introduction here. You have a huge resume. You have 16 books you have authored or co-authored. You have a very deep resume. You worked in the Reagan administration in the early 80s on his economic council. You have all kinds of awards and prizes. You've done a lot of research in economics. You truly understand the big picture. So I want people to understand who they are hearing from. And so I want to get into how, and I don't mean to be a prophet of doom. Off camera, I said, I don't store food. I'm not a gun buyer. I'm not, but the math of the economic situation is just awful. And and I don't think people realize how bad it is. And to your point, they say we have $1 trillion a year deficit, and it's way more than that. Could you please explain how indebted and how we come up with these enormous debt numbers that you've come up with, $222 trillion in real debt and $11 trillion, gap accounting, actual accounting of debt, year over year?
Well, economics has one way for measuring a country's solvency, whether it can sustain its fiscal policy. And it's pretty simple, actually. It's like a balance sheet. On the one side of the ledger are the assets. And the assets for a country, for a government, are all the taxes that are coming in through time. And they have a certain value in the present. That's called the present value of the future taxes. And then there's the liabilities. The liabilities are the present value of all the future spending commitments. And I'm talking about not just commitments to pay interest and principal on government debt, but for paying for the government's lunch over time, paying for the military, paying for Social Security, Medicare, Medicaid, food stamps. Now, the Congressional Budget Office projects out 75 years all these taxes and all this spending, and so you can extend those projections out beyond, and you form a present value of all the liabilities minus all the taxes, and the difference is $222 trillion. That's what we economists call the fiscal gap. That's what economics says we should measure. And what we're measuring is really focused on just one aspect of this fiscal gap, the $11.8 trillion official debt. But the true measure of our solvency or insolvency is $222 trillion. It's not $11.8 trillion. So all the liabilities that the government is facing, most of them, like 19 out of 20 of them, have been put off the books. Congress and the administrations over the last 6 decades have been using language to keep most of the bills off the books.
And you put them all on the books. You put all the bills onto the books. Here's what we really owe.
Books. That's it, exactly. And it's not me, it's economics, okay? Economic science says this is what to do, our math. So any graduate student around the world is taught about the government's intertemporal budget constraint that says that in present value, all the future spending is got to be covered by all the future taxes. And
that's why they lie.
Yeah, and the gap between the spending and the taxes in present value is called the fiscal gap. So that's the degree to which the fiscal gap is measuring the degree to which this fundamental budget constraint called the government's intertemporal budget constraint is not being balanced. So yes, Congress has used words to really conceal the problem. And that's still happening right now because the president says, for example, that Social Security doesn't have a long-term problem. It just needs to be tweaked or not a major problem. But that's looking very short-term. Maybe it's looking 10 years. Maybe it's looking just at the 4 years of this administration, of its life. But if you look out over the infinite horizon, over the really long term, Social Security's got a funding problem. It's 31% underfinanced, and that's in Table 4B6 of the Trustees Report. There's a fiscal gap just for Social Security by itself, right there in the April 2012 Trustees Report. It's online. Table 4B6, the president could go take a look at it. He might want to take a look at it. It says the system's 31% underfinanced. It doesn't say it's in good shape, but it just needs to be tweaked. It doesn't say that at all. So that's the truth. There is truthful, honest, economic-based accounting, and then there's garbage accounting, and that's what's going on. And Congress has been focusing on, and the president is focused on the garbage accounting, and that's why they're always doing too little, too late. Greenspan looked out 75 years with Social Security. You know, he had the Greenspan Commission back in '83 when he was supposed to have fixed Social Security with a bunch of politicians. Now, they only looked out 75 years. Right now, how many years are we beyond 1983? Well, it's 30 years, right? So it's 30 years that they ignored. 30 years are now in the current 75-year projection window that they ignored. Had they truly looked out over the infinite horizon, they would not have ignored those 30 years that we're now looking at in the 75-year window, and they would see that they hadn't done enough. So we're always doing too little, too late. We're always digging ourselves a deeper hole. It's like operating partially on cancer. That's the problem here.
Well, if you take a look at the Cyprus banking system and spread it out to how weak the system is and how indebted we are, most people don't really understand that the problems we face aren't for our kids and our grandkids anymore. They're for us. Is that correct?
Well, yeah. The game plan that we have is to leave all the bills to our kids, but that's not going to work out for us because our kids only have so much to hand us. Okay, they only have all their earnings to give us, and beyond that, and before we start taking all their labor income away from them, they're going to leave the country. So this is going to come and haunt, come and bite us in the tush, we baby boomers and even current retirees, and it's going to happen in the form of, at some point, a crash in the bond market. Interest rates are going to skyrocket, and we'll probably have high inflation because the government is printing money out the wazoo. It's absolutely incredible what the government's been doing in terms of the money creation.
You said they've tripled the monetary base, tripled the money, the amount of money they've made.
Yeah, and the Fed right now is printing $85 billion a month. It's a huge amount of money creation. And for every dollar the federal government is spending, 12 cents of it is now just being printed. That's the reality of what's going on. If you look at the numbers, 12 cents is just being, they're just going to the printing press, printing 12 cents out of every dollar, $12 out of every $100, and that is ultimately going to lead to very high inflation, if not hyperinflation.
One of the things I fight on my website all the time is trying to tell people how dire it is that we don't really have a $1 trillion deficit. I mean, that's just what they're printing a year, $1 trillion. That we really have, the Chinese say it's, 6.4 trillion. John Williams says the real annual deficit, if you count everything, is near 7 trillion. You say it's near 11 trillion. Are real deficits.
It's not me. I think, you've got...
Well, I mean, the calculations you use.
The calculation economists use.
Okay.
That's the big difference here, okay? We've got, what is Obama? President Obama is a brilliant man, but he's trained as a lawyer. We've got, I don't think there's a single PhD in economics in Congress. Okay. I don't know if any PhD in the cabinet except the chairman of the Council of Economic Advisors, who doesn't seem to be a specialist in fiscal policy. The head of the National Economic Council does not even have a PhD in economics, or if he does, it doesn't sound like it. That's Gene Sperling. So, so we have economic policy being made by people that don't have any training in economics. They don't even know how to think about the numbers correctly, and it's partly that people are confused. The members of Congress don't understand what numbers to look at, so they just grab whatever's convenient, and they try and get reelected. That's their goal in life, as opposed to doing something useful.
The last time you were on USAWatchdog.com, I asked, are you worried? And you said, yes, I'm worried. I'm worried that we're reaching a breaking point. I think that's almost your exact words. And then up pops Cyprus. And everybody thought the European crisis was over. And really, we're not talking about Cyprus. We're talking about the rest of Europe. And that's the real reason. Nobody really cares about what happens to Cyprus in the big picture. But they do care if it touches off these fissures and these bank runs in Europe. how weak is Europe, and how does the Cyprus situation expose the weakness of them?
Okay, well, all the banks in Europe and even in the U.S. and around the world are predicated on a trust me relationship with their clients. Where they say, give me your money, either in the form of deposits or you'll buy some of my bonds. I'll take in your money. I'll promise to pay you back. You'll get your money back. Don't worry. Then I go invest in risky things, which may lose value. Now, the Cypriot banks, the banks in Cyprus, invested in Greek government bonds. So they lost the value of their assets, went down. They've got these liabilities, these obligations to pay back, and a lot of them are on demand. They're demand deposits where the bank is being forced to, has said, we'll pay you back as soon as you want your money. Now, that's leveraged banking. That's extremely dangerous, and it is going on throughout the world. And what happens then is that you can have any bank throughout the world be subject to a run where people all of a sudden say, I want my money back, and the bank can't get the money, can't get the assets to hand back to cover the liabilities. So this bank run that we're seeing in Cyprus, and it's being stopped because of controls, you can't get your money out, that could lead people, whether or not there's a full-fledged bank run in the sense that the banks are emptied in terms of all the money that's left in the banks is paid out, or whether the banks continue to deny people their access to their money. The folks in Greece and in Italy and in Spain and Portugal and Ireland, Belgium, in all these countries where they know the banks are a little bit dicey and the governments are dicey, they could decide overnight, look, what happened in Cyprus to their deposits could happen to my deposits in my local bank in Athens. I'm going to go get my money out. I'm going to get it out today. So we could see bank runs. The rich people are already running on the banks in these countries, okay? The rich people, the rich Italians are taking their money out and putting it in Germany. That's been going on for over a year. The everyday people, the working men and women in these countries could start visibly running, and that could spread just like wildfire throughout Southern Europe and then into Northern Europe and then into the U.S.
It could affect us here in the U.S.
Yeah, because we have a banking system that's built to fail. And I've written a book called Jimmy Stewart is Dead about how to fix the banking system, to get rid of the leverage and to get rid of the opacity so that we can actually have a banking system that's safe. Because the special things about banks, if a company like an automobile company goes under, it doesn't necessarily bring down the whole economy, right? But if the banks go under, they do real damage to the overall economy because, why? Because they're running the financial highway system. They're providing a public good. They're making the market. So we don't want people that are providing a public good to go bankrupt. We wouldn't want all the gas stations. Think about all the gas stations going bankrupt on, tomorrow. And what would happen? The owners would leave their, they wouldn't be able to pump any gas, and the highway system would break down, and the whole transportation system would break down. The economy would be dead in the water. So we have to preserve that public good, the highway system. The financial highway system is a public good. We don't want people gambling with public goods. That's what we're doing when we let the banks operate with leverage. And nobody has put a
And that's why you say they're designed to fail. There's so much leverage that someday they will fail because it's just a matter of time.
They're unsafe at speed. This is just a matter of time before we have it's set up to fail, and Cyprus is just an example, the latest example. Over the history of of the last 2 millennia, we've seen bank failures. You go back to Spain, you go back, in the 1500s, and we've seen financial and fiscal crises and the interaction of the two. So we have to be very careful about our financial system so that it doesn't break down. And that's a safe way to do it.
So what's going on, what could be going on in Europe, which is these runs, these electronic runs by the wealthy, which I didn't know that. They're already running on the banks and moving their money. I mean, everybody thinks that this couldn't happen in America, that we couldn't have a problem in America, And the last time you were on, you said, hey, I think we're reaching a breaking point. Are we reaching a breaking point? A. B, could we have bank runs in America? Could our system collapse?
Well, 2008, we had a nice big bank run on Lehman Brothers, and they shut down. People were trying to get their money out the days preceding Lehman's collapse, and then they just closed the door. So we saw. So what the government has been doing in our country has been printing lots and lots of money. Now, if people start seeing inflation associated with that way of trying to resolve these banking crises, because the government's printing a lot of money, and a lot of it they're giving to the banks to try and shore things up. But if people realize how much money's been printed, and they start making money into a hot potato, and they start being worried about inflation, then what's going to happen is that people are going to want to get their money out in order to spend it before prices go up. So you can have, there's runs that can occur in different ways. In other words, it's not just always the Jimmy Stewart, who's a guy in, the banker in Bedford Falls.
Right.
And It's a Wonderful Life.
Your money is in Joe's house. Your money is in Bob's business. Your money is down the street.
Not always that a bank run shows up in the form of people inside the bank or long lines of people outside the bank. We had, in effect, a bank run, major proportions right after Lehman. Lehman was hit by a run, and then the entire financial system froze up, and that's, in effect, a run, because if you're not putting your money in, then people were routinely putting money in as they took money out. They're keeping money in the bank, but what happened right after Lehman is that they wouldn't put money back in. They took money out but wouldn't put it back in. And so that, in effect, constituted a run, too. And you can have a run just to deal with inflation, the fact that if prices go up, you want to get your money out quickly so you can spend it and buy something like cans of soup before prices go up even further.
So you're worried about inflation here in America?
I'm worried
about tripled the money supply.
We have a fiscal policy that's out of control. We've got a monetary policy that's out of control, that's enabling the Congress to engage in this kind of behavior. Bernanke is trying to do his best, but I don't think his best is that good, okay? Because even though he's a friend of mine, I have a very high degree of respect, and if I sat down with him, he might be able to convince me otherwise. But I think what he's doing is enabling Congress to engage in fiscally irresponsible policy by keeping interest rates low. And the danger, he's doing this at a huge risk, which is inflation. And we've seen countries engage in this kind of behavior who've got a fiscal policy that's fundamentally out of control. They engage in this kind of monetary behavior, they end up with high inflation. We've seen this 20 times in the last century, hyperinflation associated with fiscal policy and compliant central banks. Fiscal policy out of control and compliant central banks. That's what we've got here. Totally out of control fiscal policy, extremely compliant central bank. Even though Bernanke doesn't sound like that, he sounds like a very responsible, mature guy. But that's, effectively what he's doing.
He's rolling dice on high inflation or hyperinflation.
Right.
And the close here, last time you said that you thought, I asked you, are you worried? And I'm going to ask you again now. And you said to me, after I said, are you worried? You said, yes, I'm very worried. I think we're reaching some sort of breaking point. So I'm going to close with the same question. Are you, Lawrence Kotlikoff, are you worried?
Well, this morning I moved my money out of the stock market, so maybe that's an indicator. Because I am worried about Cyprus. I'm worried about, the thing about this, Greg, is that nobody can predict how the psychology will change, when people will really get panicked and flip the economy to this bad equilibrium. If everybody runs in Bedford Falls and It's a Wonderful Life, if everybody runs, the bank goes down, Jimmy Stewart commits suicide, the town of Bedford Falls is a mess for the next 30 years. If nobody runs, everything's okay. If Jimmy can talk them out of that, George Bailey in the movie, if he can talk them out of running, everything's okay. So we have two equilibria. We have two ways the economy can go. It's very fragile. And whether his speech is going to be good enough to get people to leave their money in the bank is the question. And so that's something no economist can really predict. I just want to protect myself, and I think others should concern themselves that a situation like Cyprus, that things could actually get very, very bad very, very quickly. But it's a tail risk. I mean, it's not a high probability event. This could happen, but Lehman Brothers was a tail risk, right? Bear Stearns was a tail risk. Having 27 major financial companies fail, which we saw in 2007, 2008 around the world, that was a tail risk. So we have to be worried about those tail risks.
And even a bigger risk is not just a tail risk, implosion, but hyperinflation, inflation and hyperinflation. I mean, that's the other big risk, inflation, hyperinflation.
Yeah, and again, it's partly psychology. You know, if people decide that they're worried about inflation, then they start being less interested in holding dollars and holding money and they certainly long-term bonds. So they take steps to make the inflation happen. Just like if everybody starts worrying that everybody else is worried about bank runs, they start running before everybody else so that they can get their money out first. So you can have self-fulfilling prophecies occur. I'm worried that everybody else is running, they're worried that I'm running, therefore we all run. I'm worried that nobody else is hiring, they're worried I'm not hiring, we all lay off people.
And I wanted to get this in. I'm going to extend this interview a little longer. It's just so interesting. I think people are going to hear this. Yeah, I fight this on the site all the time. People have no idea how terrible it is, and I know why. I worked at ABC. I worked at CNN. I was an investigative reporter. I know how a story works. And what is happening in what's broadcast at the New York Times, the Wall Street Journal, CNBC, even Fox and Bloomberg, is that is the Krugman mentality, which you wrote a piece about the Krugman mentality, about all these myths that you could just print money. Is that something you fight, that people look at you and say, hey, Dr. Kotlikoff, what are you doing? Why don't you act like Krugman? Tell everybody it's okay. We could print some money. Do people give you a hard time for coming out and saying, hey, we're really $222 trillion in debt. We have all kinds of risk. I moved my money out of the stock market. People must call you up and give you a hard time, don't they, for telling the truth?
Well, there are people on the who think Paul Krugman is, the next coming or whatever, and do think that I'm out to lunch or that I have some secret right-wing agenda. They look at my resume and see I work for, as basically a junior economist for the Reagan administration. They think I'm a Tea Party member. But most people listen carefully and understand that I'm not partisan. I didn't actually even vote for Reagan when I went to work for him. I thought the country needed some help. And that's why I went to work for the country in my, piddling job. But
this disinformation campaign, I mean,
yeah.
Do you think there's a kind of a disinformation campaign going on? I mean, I listen to you and think, wow, we're in trouble. I listen to Krugman and think, hey, wow, it's nirvana.
Well, I don't know what Kool-Aid he's drinking, but it certainly doesn't correspond to basic economics. And that's what I wrote in that column about Paul Krugman's four dangerous fiscal myths or fables, which is on my website, kotlikoff.net. And so I think, he's an international trade economist. He's not a fiscal economist. And maybe he just doesn't understand this stuff that well. And he certainly changes his point. What he said 10 years ago when Bush was in office is quite different from what he's saying now. So it seems like his messages are very political. I think he's doing a huge disservice to the profession, to the economics profession. He should, I don't think he's an economist anymore. I think he's just a political economist where the emphasis is on the word political. I think there's other people that are advising politicians on the right who are very similar in that respect. So I think that the public needs to listen to academic economists that are not aligned with either party. I think that's where they can get some truth. And most people who listen to me seem to believe that, hear what I'm saying and understand that it's not my opinion, but it's just what economic science tells us to look at and to say. And so I just keep saying it. But, the politicians want to, their easy route is to to do little and just get reelected. I mean, President Obama said this in a speech the other day, that just yesterday, I think, in Israel, that unless politicians see a crisis, they won't react. And that's a terrible statement to make, because people need to go to Congress and work out of a principle that they're here to help the country, not their party, not themselves. Their job is to the country and its children.
Well, if you moved your money out of the stock market, then the danger is near and imminent.
Well, again, it may be or it may not. I may, I'm not a great prognosticator of the stock market, and I haven't done particularly well, investing in stocks over the years or timing the market. But these things are hard to predict, but they are real tail risks that can occur. The banking system is built to fail. That needs to be fixed. We should spend some time talking about how to do that, maybe in the next broadcast.
Lawrence Kotlikoff, Dr. Lawrence Kotlikoff, Professor of Economics at Boston University. Thank you for joining us today on USAWatchdog.com.
My pleasure, Greg.